In the financial system, there is an authority far more dominant than your name, your college degree, or your moral character. It is a silent but ruthless number ranging from 300 to 850. Most people view this number as just a score, like a video game point system. If it goes up, it's good. If it goes down, it's annoying. But they are dead wrong. This number is actually a price tag that banks place on your future labor, and it is the boundary of your personal freedom. If your credit score is low, it's not just that you can't borrow money, it means you are paying a hidden incompetence tax in every area of life. A low score means higher auto insurance premiums, higher security deposits, humiliating rejections on rental applications, and even being filtered out of high-level job opportunities. If your credit score is 640, you could end up paying over $150,000 more in interest over 30 years compared to someone with a 780. That is 3 full years of your life, 3 years of your children's inheritance, handed over as a gift to bank shareholders simply because of a number. Today, we are going to dismantle this system in its own laboratory. I am going to show you how to increase your score by 100 points in a single year using the surgical maneuvers that bankers never whisper to you. This is not a quick fix guide. This is an operation to scrub the rust off your financial reputation and break the invisible economic embargo the banks have placed on you. Welcome back to the mortgage trap. Grab your calculator, your coffee, and your notebook. Today, we are auditing your financial identity from the ground up. 1. The algorithm's architecture, decrypting the underwriter's logic. To defeat the system, you must first understand the logic of your executioner, the FICO algorithm. When you apply for a mortgage, the lender doesn't care about your dreams or your family's needs. They consume raw data to calculate risk. To reclaim those 100 points, we must conquer the 5 pillars of the Tri-Merge report with absolute precision. Payment history, 35%. This is the foundation. To a mortgage underwriter, a single 30-day delinquency in the year before buying a house is a code red. It suggests financial instability. Credit utilization, 30%. This is the shadow of your debt-to-income, DTI ratio. It's not about how much you can borrow, but how much of your current limit is occupying your credit capacity. Length of credit history, 15%. This is the age of trust. The bank wants to see that you have been a reliable subject of the debt system for a significant amount of time. Credit mix, 10%. Can you handle different types of debt, or are you just a credit card spender? New credit, 10%. This measures your financial hunger. How desperately are you hunting for new lines of credit while asking for a $500,000 home loan? 2. The payment isolation strategy, sanitizing the pre-mortgage window. If you have a late payment from the last 12 to 24 months, your 100-point goal begins by isolating this stain. Mortgage lenders look for patterns. A late payment in 2019 is a mistake. A late payment in 2025, the year you want to buy, is a disqualifier for the best rates. The auditor's counterattack. If you have a one-time slip-up, you must execute the goodwill letter campaign. Write a professional, concise letter to the original creditor. Explain that you are preparing for a primary residence purchase and request a goodwill deletion of the delinquency. While many are rejected, a single yes can spike your score by 50 points in days. If the stain remains, you must enter a state of total compliance. For the 12 months leading up to your application, you cannot be a single day late. Your auto pay is no longer a convenience. It is your most vital defense mechanism. 3. The utilization pivot, the DTI death trap. The 30% utilization rule is a myth designed for the average consumer. For a prospective homebuyer, 30% is a mathematical catastrophe. Mortgage lenders look at your debt-to-income DTI ratio. High credit card balances, even if paid on time, suggests that your monthly income is already claimed by other creditors. The execution. You must pivot your utilization to between 1% and 3%. Imagine you have a $10,000 limit and a $4,000 balance. Even if you pay it off every month, the snapshot the bank sees is 40% usage. By paying this down to $100 before you even speak to a realtor, you aren't just raising your score, you are cleaning your DTI. This move alone can lower your perceived risk and increase the total loan amount the bank is willing to give you. Remember, the bank only wants to lend money to people who look like they don't need it. 4. The statement date attack, manipulating the reporting cycle. Lenders see what is reported, not what is true in your bank account today. Most people pay their bills on the due date. By then, you have already lost. The bank has already reported your high balance on the statement date, the day your bill is generated. The auditor's plan. 1. Log into your portals and find the statement closing date for every card. 2. Pay your balances to under 3%, at least 72 hours before that statement date. 3. When the mortgage underwriter pulls your tri-merge report, they won't see your actual monthly spending, they will see a ghost balance. This is the most effective way to hack your score upwards by 20 to 40 points in a single 30-day cycle without spending an extra dollar in interest. 5. The authorized user. Piggybacking. Importing institutional trust. If your credit history is thin or young, you are a high-risk entity in the eyes of a mortgage algorithm. To fix this, you must legally copy the history of a seasoned borrower. The strategy. Identify a family member with a credit card that has been open for 10+ years, has a high limit, and zero balance. Ask to be added as an authorized user. You do not need the physical card. You do not need to spend a cent. The result. That card's decade of perfect history is transcribed onto your report. Your average age of accounts doubles overnight. For a first-time home buyer, this can be the difference between a denial and a pre-approval letter. You are essentially stealing the bank's trust in someone else and applying it to your own mortgage application. 6. The no new inquiries. Fast. The pre-closing lockdown. This is where most traps are sprung. I have seen hundreds of people get through the pre-approval process, find their dream home, and then 2 weeks before closing, they go out and buy a new SUV or a $5,000 living room set on credit. The result? The mortgage lender does a soft pull or a final credit refresh 48 hours before you sign. They see a new hard inquiry and a new debt obligation. They recalculate your DTI, find you no longer qualify, and cancel the loan. The rule: from 12 months before you buy until the moment the keys are in your hand, you're in a credit fast. No new cards, no car loans, no buy now, pay later schemes. The furniture can sit on the floor of your new house. Just make sure you actually own the house first. 7. The lethal mistake. The clean slate fallacy. Many people think, I'm buying a house. Let me close all these old unused credit cards to look clean. This is a lethal error. Closing an account. 1. Spikes your utilization. You just deleted part of your available limit, making your remaining debt look much larger. 2. Kills your history. You're deleting the age of your credit. In the eyes of a mortgage underwriter, an old, unused card is a safety net. It proves you have access to credit, but the discipline not to use it. Leave the old guard accounts open. They are the only thing protecting your interest rate from skyrocketing. 8. The credit mix audit. Proving you can handle real debt. Mortgage lenders want to see that you aren't just a revolving credit user. They want to see installment history. If you have only ever had credit cards, the algorithm might plateau. If you have a year before you buy, consider a credit builder loan or a small personal loan that you pay back religiously. This adds the installment flavor to your credit mix, 10%. It proves to the mortgage engine that you can handle the structure of a fixed monthly payment, exactly what a 30-year mortgage is. Conclusion: the 100-point freedom. The 12 months before you buy a house are a financial war zone. You have two choices. You can walk into the bank with a 640 score, hat in hand, and let them dictate a 30-year sentence of high interest and predatory terms. Or you can apply this surgical audit, elevate your score to 740 plus, and sit at the table as an auditor. A 100-point increase is not just a digital victory, it is the key to a lower monthly payment, a better neighborhood for your family, and $150,000 in interest savings that stays in your pocket instead of the bank's vault. This is the true meaning of the mortgage trap. The system relies on your ignorance. Once you have the math, you have the power. If this pre-mortgage audit gave you the roadmap you needed, like the video, and subscribe to the mortgage trap. We are here to dismantle the debt machine, one audit at a time. Don't sign until you calculate. Don't apply until you audit. Break the trap and build real wealth. I'll see you in the next investigation.